WTI prices remained relatively unchanged since last week's report. In the current report, we intend to have a look at the state of the US oil market, Iraq's commitment to OPEC's production cuts, and the difference in global oil demand forecasts between the IEA and OPEC. To conclude the report, we will also provide a technical analysis of WTI's daily chart. The metrics related to the US oil market tended to provide mixed signals since our last report. Characteristically, the Baker Hughes oil rig count for the prior week dropped by 2 active oil rigs from 499 to 497 in a sign of easing oil demand in the US oil market. Yet that appears to have been contradicted, as on Tuesday the API weekly crude oil inventories figure was released, which showcased a decrease of US oil inventories by minus 3.104 million barrels. Moreover, the release of the EIA crude oil inventories report was also indicative of a drawdown in oil inventories by minus 2.508 million barrels. The drawdown was much greater than expected, implying that oil demand from US consumers over the past week has increased, which in turn may have provided support for oil prices. Overall, the release of the EIA and API weekly crude oil inventories figures seems to contradict the signals sent by the reduction in the Baker Hughes oil rig count of easing oil demand in the US. Therefore, we see the indicators continue aligning in the coming week, hence implying an increase in demand from the US oil market. We may see WTI's price getting a boost. According to various media outlets, Iraqi's oil minister stated this past Saturday that Iraq has made enough voluntary oil production reductions and would not agree to any additional cuts taken by OPEC+. In particular, the Iraqi oil minister Ghani, when discussing production, stated per Reuters that Iraq has reduced enough and will not agree to any new cut. The Iraqi oil minister does not appear to have clarified as to whether or not his comments were referring to OPEC's current voluntary oil production cuts or as to whether they would oppose a further reduction in output. The statements made by the minister appear to be indicative of a growing rift between OPEC nations, which are set to meet on the 1st of June for their meeting. Furthermore, in a more recent report by Bloomberg, the rift is once again highlighted, as it is claimed that several major exporters are seeking to have their oil production levels upgraded. Therefore, with differing agendas appearing to divide OPEC+, the group's voluntary oil production cut may be on the chopping block. Hence, with the most recent developments and the apparent unwillingness by some nations to further reduce supply, it could mitigate the desired impact by OPEC to drive oil prices and instead could weigh on the liquid's gold price. Nonetheless, we remain vigilant about any developments regarding the OPEC+ nations as the bloc's meeting nears. According to Reuters, the International Energy Agency on Wednesday reduced its forecast for the 2024 oil demand growth, hence placing the agency at odds with OPEC in terms of oil demand expectations for the rest of the year. In particular, the IEA claims that global oil demand this year will grow by 1.1 million barrels per day, which is down by 140,000 barrels per day from their previous forecast. In contrast, OPEC in its monthly report on Tuesday stuck to its expectations that global oil demand will rise by 2.25 million barrels per day in 2024. Therefore, the disparity in global oil demand forecasts may have led to increased volatility in the market, as market participants appear uncertain as to who they should listen to. In conclusion, it should appear that the disparity in the two reports may have cancelled out each other's impact on oil prices. In particular, the OPEC report may have provided some support for oil prices, while the IEA report may have weighed on the liquid's gold price. WTI's price appears to have floated just above the 76.55 support line since the 2nd of May. Nonetheless, we maintain a bearish outlook for the commodities price, and supporting our case is the downwards moving trend line, which was incepted on the 5th of May, in addition to the RSI indicator below our chart, which currently registers a figure near 40, implying bearish market tendencies. Furthermore, the Bollinger Bands appear to be tilted to the downside, which may also imply bearish market tendencies. For our bearish outlook to continue, we would require a clear break below the 76.55 support level, with the next possible target for the bears being 71.50 support line. On the flip side, for a sideways bias, we would require the commodities price to remain within the sideways moving channel defined by the 76.55 support level and the 81.80 resistance line. Lastly, for a bullish outlook, we would require a break above the 81.80 resistance line, with the next possible target for the bulls being the 85.85 resistance ceiling. Those were the top financial stories for this hour. From all of us here at IRON FX, we wish you a solid trading.